All right, hello everyone. What we're going to do here briefly is I'm going to walk you through the in-class spreadsheet example that we completed last Thursday, during which we kind of reviewed this hypothetical $3 million Grandpa Joe, Grandma Sally property that is being traded perhaps on an off-market basis, which means that it hasn't been listed with a broker. It is basically in the course of your business dealings. Maybe you called Grandpa Joe and Grandma Sally, asked them if they'd thought about selling or exchanging the property. In the course of this conversation, I think either Grandpa Joe or Grandma Sally or both said, yeah, we'd like to get $3 million for the property. And oh, by the way, here is some basic operating data for you that you've been able to glean over the phone during your conversation. All right. So now what we've done is we've basically said, okay, Grandpa Joe, I understand and I get it. But what we're going to do here is we're going to take a look at some basic stuff that we know. We know that in this instance, Grandpa Joe wants $3 million for the property. Okay. We also know that in the course of our conversation, they've mentioned some operating data, all right? Some gross potential rents, a vacancy rate, some other vending machine income, and we then calculate the effective gross income. The operating expenses or the operating ratio here is 30% of the effective gross income. We know that's 79,875. Now, I did as well post in this week's module a hand coding of all of these calculations, but I did want to go over this briefly with you in spreadsheet form so you can kind of get a handle on the process, at least that I go through when I take a look at an investment opportunity, either for myself or for a client or for a group that I might be putting together. All right, so this is the basic way that I do this. Now, are we going to have more detailed operating expense information? Maybe, maybe not, right? This is off market. This is a mom and pop owner. They may not have operating data month by month. So in fact, some of these receipts might even be in a shoebox. All right. So this is what we've been able to glean, at least from Grandpa Joe and Grandma Sally. The first step is to reconstruct the operating statement, which we've clearly done here. All right. We've come up with a cap rate of 6.21%. All right. That's the first step. The second step is we need to determine the extent to which leverage may be available for the property. And in order to do that, we need to get a loan quote. The lender here in this instance, call it Bank of Fred, Bank of Sally, doesn't make any difference. Bruin Bear Bank, Tommy Trojan Bank. Oh, I can't believe I said Trojan. The bank says, I'll name that tune or I will loan you the money subject to two constraints. There's going to be an LTV and a DCR constraint. LTV means loan to value. Okay. DCR means debt coverage ratio. Now I'm typing up here 1.20. Right now 1.20. I want to take this back here to 1.20. Right. What this means, and we're throwing you right into the fire. A lot of these terms actually, and some of these metrics, we're going to go over not this Thursday, but I think the following Thursday. I think it is. We'll see. But in any event, what you need to know for now is that LTV means loan to value. The lender will provide some percent of the purchase price as a loan. It's going to be constrained in one of two ways, either loan to value or debt coverage ratio. The debt coverage ratio quoted here is a 1.2 DCR. All right, over here, 1.2. What this means is that when a lender quotes a coverage ratio or a DCR or coverage or debt coverage, synonymous terms, what they're saying is that this 0.2 right here, what they're saying is that the point XX, whatever the XX is, this 0.20, this means that the lender says that 20%, the 0.2, right? 20% of the net operating income here of 186,375, 20% of that cannot be used for debt service. That must remain in reserve. That's basically what a debt coverage ratio is trying to do. The DCR is saying we need to take your net operating income and divide it by 1.2, then take that result and divide it by 12 in order to get to the maximum allowable monthly payment. Okay? So take a look here what I've done. We said in the fact pattern that the rate is going to be, the interest rate is going to be tied to some index. In this instance, this 10T is the 10-year Treasury bill. That's a very common index for commercial loans. And at that time, the bank said it was trading, the 10-year T-bill was 2.50. It might be different today. Who cares? It doesn't matter. It's the same methodology. That's all we're talking about right now, gang, is process. Just the method, all right? The bank also said that in addition to the 10-year Treasury bill index, we're going to charge you a margin of 2.5%. This margin is the bank's markup on the money. The bank is going to borrow the money from the Fed at 2.50%. They're going to mark it up 2.50%. This is also known as 250 BPS. 250 basis points is 2.50%. Okay? When we add these two together, we then get 5%. That will now be the note rate. The note rate is the interest rate on which the payment will be based. Okay? So now, we know as well that the origination points in the fact pattern are 1%. So whatever the funded loan amount is, the bank is going to charge you a fee for the pleasure of borrowing their money. Okay? And they're going to charge you a 1% fee of whatever the qualified funded loan amount is. In addition, we said in the fact pattern that there is a prepayment penalty, meaning that if we pay off this loan, I think the loan quoted was a 30 due in 10. If we pay off this loan too early, the bank is going to charge us a 2% prepayment penalty. That penalty will be based on the amount of payoff at the time that we pay off the loan. We know we're going to get hit with this prepay. Why? Because in the fact pattern, it said the strategy was to what? Hold it for 5 years. 5 years is earlier than 10, therefore we know we're going to get hit with a prepayment penalty. Okay, now I'm going to take this down just a little bit. Now, this is what we do in this regard. We know that we can purchase the property for $3 million. We have a 75% loan to value first constraint, so we take $3 million, multiply it by 75%, we get $2.25 million. Bam, bam, thank you, ma'am. Real quick and easy loan to value calcs. Can do this blindfolded with one hand tied behind your back, I'm sure. The debt coverage constraint, though, gets a little bit trickier, gets a little bit more complicated, but if you follow me through with it, it should become pretty clear, especially after you practice this a few times, several times. What we do is we first have to reconstruct an operating statement. Why? Because we need to get to the NOI. NOI right here is one of the inputs that we're going to use in order to get to the coverage constrained loan amount. We take the net operating income divided by the debt coverage ratio divided by 12. You will see this handwritten in the hand-coded calculations in this module. All right? I also did a video on those hand calculations. So we know that the net operating income is $186,375. We know that the coverage is 1.2. That's in the fact pattern. We know that we divide that by 12. Therefore, the maximum payment allowable in this quoted scenario is $12,943 per month. What we're trying to do here is we're trying to get to what is my maximum payment. Okay, we just did that, $12,943. Then, what do I know, right? I know I must have at least 3 knowns to solve for any one unknown. We covered that in our very first class in the course. So therefore, I've solved for the maximum payment. I know then that this is PMT. I know that. I know the term is 30 years or 360 months. I know the due date is 10 years hence. My note rate, or my I, is 5%. I'm going to code that as I. I'm going to code that as PMT. I'm going to code that as an N. And this is my result. This is my present value. Okay, this loan also is a result of present, the resultant is present value. This is the maximum amount of loan that I will be able to achieve given either of these two constrained scenarios, either LTV or DCR. Okay? What else do we know? This is a present value, if you can see that up here. This is a present value calculation. Okay? This is just a result of multiplying 3 million times 75%. In this scenario, we have to plug in a present value calculation. Okay? We therefore know then that the loan to value constraint is less than the DCR constraint. 2.25 million is less than 2.41 million, even with new math. This is the lesser of these two amounts. Therefore, I know that the maximum amount of loan I can get on this deal at this loan program and with this rate is $2.25 million. I therefore have present value. I therefore also know that my N is going to be 360 months. My I is 5%. That's my note rate. I already determined that. Okay, I'm going to hold this for 5 years or 60 months. I have to then go through a couple of different calculations here. I've got to calculate the amount of the loan at time of payoff in order to add my 2% prepayment penalty. Okay, do you see this here? This amount here, the 2.107, is my amount of loan payoff plus my 2% prepayment penalty. Okay. I know that in the very beginning, I'm going to qualify for 2.25 million right here. So I bring that down here to the present value. I know that the lender is going to charge me a 1% fee. I've already determined that. That's part of the loan quote. So this 2.2275 is 99% of my present value, right? This amount here is 102% of my payoff. This adjusted present value is going to be 100% of my present value minus 1%, therefore 99%. Do you see how that works? My payoff is going to be greater than my total payoff is going to be, including the prepay, is going to be greater than my 60-month hold payoff because I'm paying it off early. The bank's going to hit me with a 2% prepay. I also know that my funded loan amount here of 2.25, if I impute the point, has to be 99% of this face present value. All right. Then to calculate the effective cost of debt, this is a rate function here in Excel. I get to the rate and I multiply by 12 because this returned rate, if I only left it at not being multiplied by 12, this is the monthly rate. Okay. But I'm trying to determine the yearly rate. That's the effective cost of debt. So I have to multiply this rate calculation up here times 12 in order to get to the yearly percentage rate. My last and final step here is to take the cap rate less the effective cost of debt, and that gets me to my leverage. I know that the cap rate is 6.21 because I've already calculated it on the reconstructed operating statement. I know that my effective cost of debt is 5.57, call it, because I've done this in my determining the maximum amount of present value for the loan, right? Therefore, my cap rate less my effective cost of debt will equal then my leverage. If this were a negative number, we know we would have negative leverage. Because it's a positive number, even though it's less than 1, it's still a positive number. Because of that, I then know that my leverage is positive leverage. If this were 0, that would mean that my leverage would be neutral. the cap rate and the effective cost of debt in neutral leverage are equal. Okay? Always remember this in conclusion. Let me put it this way. Positive leverage is always good under all circumstances. Negative leverage is not necessarily bad, but if you read the articles posted at the week 3 folder in Canvas, you will know that we need to move it to positive leverage as soon as we possibly can. Right? That's the goal. Positive leverage magnifies our return on equity in a positive way. Negative leverage magnifies leverage in a negative way with negative leverage. All right? Neutral leverage, there's no effect. I would be indifferent on the financing in neutral leverage. All right, so I'm hopeful that that kind of explains it a little bit better. That then concludes our walkthrough of the week, I think 3 spreadsheet. Is that week 3? Week 3? I think it was week 3. I'm hopeful that helps. I'll see you all quite soon.